Hello everyone and welcome back to another video. In today's video, I would like to talk about 5 stocks that are worth investing in right now. Be sure to watch all the way through to get my full analysis of each of these companies. So the very first stock on my list is Marico. Marico Limited is a consumer products company operating in the beauty and wellness space. The company's principal products include edible oils and value-added hair oils. The company's brand include Parachute, Nihar, Saffola, Hair and Care and Livon. Right now, Marico is trading at 504 rupees with a 52-week low of 379 rupees and a 52-week high of 607 rupees. If we take a look at their 1-year price chart, we can see that Marico has given a decent return of 20.69% to its investor in the last year. Marico is a large cap company with a market cap of 64,852 CR. They have a PE ratio of 54.1 versus industry PE of 33.3. And they have earnings per share of 9.22 rupees and they pay a dividend of 1.49% and a price to book value of 16.5, which is insanely high. And when it comes to profitability, right now Marico has an operating profit margin of 18% and return on equity of 36.7% and their return on capital employed is 44%. And if you take a look at the shareholding pattern of Marico, promoters held 59.52% stake in the company while FIs held 25.92%, DIS 8.5% and public 5.87%. Last year they have generated total sales of 8,048 CR with a net income of 1,172 CR. In the recent quarter, Marico's total revenue has increased by 21.23% year-on-year to 2,444 CR and net profit has increased by 17.05% year-on-year to 309 CR. And looking at the balance sheet, we can see that they have total cash equivalents of 1,049 CR and the company has a debt of 367 CR and their debt to equity ratio is 0.09, so the company almost looks debt free with a free cash flow of almost 2,000 CR, which I love to see. Over the last 5 years, revenue has grown at a yearly rate of 8.07 versus industry average of 5.58%, and over the last 5 years net income has also grown at yearly rate of 10.5% versus industry average of 9.83%. so all these numbers looks pretty decent to me and it has the potential for high growth in the future. And as far as what analysts say, they are currently rating Marico as 2.6, meaning it is a buy, and the current average analyst price target is 633.89 rupees, an expected return of 26.2% from the current price level, which is more than the last 3 year CAGR of 15.39% and expected revenue growth of 21.42% for the next year, which is more than the last 3 year CAGR revenue growth of 9.06%, and it is among the top performance in quality checks and satisfactory performance in growth score as well, and the company has low probability of default in the next 12 months. So yeah, overall Marico looks very strong with its fundamentals and could be a great pick for the long term in my opinion. And the second stock on my list is HAL, Hindustan Aeronautics Limited. Hindustan Aeronautics is an Indian state-owned aerospace and defense company engaged in the business of manufacture of aircraft and helicopters and repair. Right now, HAL is trading at 1,233 rupees with a 52-week low of 856 rupees and a 52-week high of 1,556 rupees. If you take a look at their 1-year price chart, we can see that the company has performed quite well in the last year. HAL is a mid-cap company with a market cap of 41,253 CR. They have a PE ratio of 11.7 versus industry PE of 24.4, and they have earnings per share of 105 rupees and they pay a good dividend of 2.43% and a price to book value of 2.5. And when it comes to profitability, right now they have an operating profit margin of 23.2% and a return on equity of 22.6% and their return on capital employed is 26.2%. And if you take a look at the shareholding pattern, promoters held a 75.15% stake while FIs held 2.29, DIS 5.4% and public 17.16%. Last year they have generated total sales of 22,755 CR with a net income of 3,239 CR. In the recent quarter, HAL's total revenue has increased by 15.17% year-on-year to 5,691 CR and net profit has increased by 37.64% year-on-year to 846 CR, and they have a total cash equivalent of 13,569 CR and their debt to equity ratio is 0 and the company has a debt of only 6.31 CR, so we can consider this company debt free, and they have a free cash flow of 13,947 CR, which is just amazing in my opinion. Over the last 5 years, revenue has grown at a yearly rate of 4.71 versus industry average of 1.94 only, and over the last 5 years their net income has also grown at a yearly rate of 10.08% versus industry average of 6.39%. As far as what analysts say, they are currently rating HAL as 1.2, meaning it is a strong buy, and the current average analyst price target is 1,814 rupees, and it is among the top performance in quality checks, checks and satisfactory performance in growth score as well, and the company has a low probability of default in the next 12 months. So yeah, in my opinion, Hindustan Aeronautics could be a great pick for long-term investors like me. And now let's move on to the third stock, and this is Mahanagar Gas Limited. Mahanagar Gas Limited is a natural gas distribution company. The company is engaged in the distribution of compressed natural gas and piped natural gas in Mumbai and its adjoining areas. Right now, MGL is trading at 876 rupees with a 52-week low of 834 rupees and a 52-week high of 1284 rupees. MGL is a small cap company with a market cap of 8652 crore. They have a PE ratio of 10.3 versus industry PE of 10.7, and they have earnings per share of 84.9 rupees, and they pay a very good dividend of 2.63% and a price to book value of 2.47. And when it comes to profitability, right now MGL has an operating profit margin of 43.8%, which I love about this company, and return on equity of 20%, and their return on capital employed is 26.6%. And if you take a look at their shareholding pattern, promoters held a 32.5% stake in the company, while FIs held 29.38%, DIS 17.8%, and public and others 20.32%. Last year they have generated total sales of 2153 crore with a net income of 620 crore. In the recent quarter, MGL's total revenue has increased by 62.38% year-on-year to 852 crore, and net profit has increased by 41.53% year-on-year to 204 crore. MGL has a total cash equivalent of 393 crore, and the company has a debt of 74.5 crore, and their debt to equity ratio is 0.02, so the company almost looks debt free with a free cash flow of 466 crore. And the current average analyst price target is 1295 rupees, which is an expected return of 47.85% from the current price level and expected revenue growth of 44.81% for the next year. And it is among the top performance in quality checks and satisfactory performance in growth score as well, and the company has a low probability of default in the next 12 months. So yeah, this company is also providing a great long-term investment opportunity. And the fourth stock on my list is Heritage Foods Limited. Heritage Foods Limited is a fast-moving consumer goods company. The company segments are dairy, retail, agri, bakery, and renewable energy. Right now, Heritage Foods is trading at 401 rupees with a 52-week low of 269 rupees and a 52-week high of 565 rupees. And if we take a look at their one-year price chart, we can see that the company has performed quite well in the last year. Heritage Food is a small cap company with a market cap of 1895 crore, and they have a PE ratio of 15.5 versus industry PE of 43.7, which means it has a high potential for growth in the future. And they have earnings per share of 24.5 rupees, and they pay a dividend of 1.25% and a price to book value of 2.93. And when it comes to profitability, right now Heritage Food has an operating profit margin of 8.53% and return on equity of 28.6%, and the return on capital employed is 31.1%. And if you take a look at the shareholding pattern, promoters held 39.49% stake, while FIs held 3.47%, DIS 14.26%, and public 42.78%. Last year they have generated total sales of 2473 crore with a net income of 150 crore. In the recent quarter, their total revenue has increased by 10.04% year-on-year to 673.2 crore, and net profit has increased by 1125% year-on-year to 32.71 crore. And right now they have total cash equivalent of 73.1 crore, and the company has a debt of 37 crore, and their debt to equity ratio is 0.06. So again, this company also looks debt free with a free cash flow of 108 crore. And as far as what analysts say, they are currently rating Heritage Food as 1.8, meaning it is a strong buy, and it is also currently trading below its intrinsic value. And the current average analyst price target is 612 rupees, which is an expected return of 52.63% from the current price level and expected revenue growth of 12.32% for the next year. And the company has a low probability of default in the next 12 months. So yeah, this company looks quite good to me as well, and it could be a great pick as well. But alright, now let's move on to the fifth stock, and this is SAIL, Steel Authority of India Limited. SAIL is one of the largest steel making companies in India and one of the Maharatnas of country's central public sector enterprises. SAIL manufactures and sells a broad range of steel products. Right now, SAIL is trading at 110 rupees with a 52-week low of 55 rupees and a 52-week high of 151 rupees. SAIL is a mid-cap company with a market cap of 45,477 crore. They have a PE ratio of 3.42 versus industry PE of 6.58, and they have earnings per share of 31.9 rupees, and they pay a very good dividend of 3.63% and a price to book value of 0.86. And when it comes to profitability, right now they have an operating profit margin of 27.4% and return on equity of 9.51%, and their return on capital employed is 11.2%. And if you take a look at the shareholding pattern, promoters held 65% stake, while FIs held 5.38%, DIs 12.46%, and public 17.09%. Last year, they have generated total sales of 69,114 CR with a net income of 4,148 CR. In the recent quarter, sales total revenue has increased by 55.71% year-on-year to 27,083 CR, and net profit has increased by 893.94% year-on-year to 4,338 CR. And they have total cash equivalent of 964 CR, and the company has a debt of 24,702 CR, and their debt to equity ratio is 0.47, and they have a free cash flow of 19,901 CR. As far as what analysts say, the current average analyst price target is 151.46 rupees, which is an expected return of 37.56% from the current price level and expected revenue growth of 35.06% for the next year. And it is among the top performance in quality checks and satisfactory performance in growth score as well. And the company has a low probability of default in the next 12 months, so this stock looks overall okay to me, and it's worth investing in for the long term. Alright, so that's going to wrap up the video, everyone. I hope you guys got some good information out of it, and please remember, before investing in any stocks, you need to do your own due diligence. It's very important that you do your own research first and then make a decision. And if you enjoyed this video, then please remember to leave a like on it. It really helps up my channel and I really appreciate it. Thank you all so much for watching, and I hope to see you all again in my next video. Have a good day.